Welcome to the Deep Dive, where we're digging into the story behind the numbers. And today, we are unpacking the first quarter fiscal 2026 earnings call for Northern Technologies International Corporation, or NTIC.
And this one is a truly fascinating story. It came out pre-market this morning, January 8th, and it gave us this real dichotomy. You had record sales on one hand,
Right.
and on the other, some really surprising pressure on their profits.
Yeah.
The way the market reacted tells you everything you need to know.
Okay, so let's unpack that. Let's start with the good news, because the headlines, they looked great.
It looked fantastic.
NTIC delivered record consolidated net sales of $23.3 million.
Yeah, which easily sailed past what analysts were expecting. Consensus was, somewhere around 20.7 million?
Mm-hmm.
So a really strong beat.
That's a 9.2% jump year over year. I mean, it shows real demand for their ZERUST corrosion stuff and their NATUR-Tec bioplastics.
And it wasn't just the top line. The earnings per share numbers also looked good, at least at first glance. Their GAAP EPS and their adjusted non-GAAP EPS both beat.
The street was looking for about 2 cents a share, right?
Yeah, and they came in at 3 and 4 cents. So on paper, it's a textbook beat. Sales are up, earnings are up.
So why the panic? Why did the market react so badly at the open? This is where it gets interesting, because despite that strength, everyone zeroed in on the operating income.
That's the friction point. That's what spooked everybody. I mean, operating income didn't just dip a little bit. It was essentially cut in half.
Wow.
It fell from almost $1 million a year ago to just under $400,000 this quarter.
Okay, so where did that pressure come from?
It was almost entirely from the gross margin. It got squeezed.
Let's just quickly define that, because the difference here is key. Gross margin is what's left after you pay for the actual stuff you sell, the raw materials.
Right. And operating income is what's left after you pay for everything else. Sales, marketing, all the overhead.
And that gross margin fell from 38.3% last year all the way down to 36%.
Exactly. And management's story, their official line, is that this was a temporary supplier lead time issue. That's the key phrase.
So they're saying they had to pay more to get materials or ship things faster to meet that record demand, and it hit their profits in the short term.
That's the story. And the big question for investors all day was, is that credible? Is this just a temporary blip, or is it a sign of a deeper problem with their pricing power?
Right. Because if it's a structural issue, then it doesn't matter how much they sell, the profits won't follow. And that was the initial harsh takeaway from the market.
For sure. But to understand why the narrative shifted, you really have to look at where that record revenue actually came from.
Okay, so let's break it down. Where did that $23 million in sales come from?
The demand was pretty strong across the board. ZERUST Industrial, which is their core corrosion protection business, that was up almost 7% to $16.6 million.
The backbone of the company.
Still the backbone. And NATUR-Tec, their bioplastics segment, also hit a record for the quarter. $6 million in sales, up about 2%. Mostly driven by North America.
But that's not the breakout story. The real fireworks, the thing that I think really turned the tide during the trading day, was the ZERUST oil and gas segment.
Oh, yeah. I mean, sales there hit $2.4 million. That is an astronomical 58.1% jump year over year.
58%.
It's not a typo, and it's driven by domestic demand and, crucially, by their subsidiary in Brazil.
And that Brazil story, it's more than just a good quarter. It gives them this incredible revenue visibility, which is like gold in the energy sector.
It is an absolute game changer for them. The Brazil subsidiary landed a 3-year contract valued at roughly $13 million. For a company NTIC size, that is a huge, huge deal.
And this is for protecting FPSOs. Can you just quickly explain what those are?
Sure. It stands for Floating Production, Storage, and Offloading Unit. So picture a giant repurposed oil tanker that sits over an offshore oil field. It processes the oil, stores it, and then offloads it. They are massive, critical pieces of infrastructure.
And they operate in extremely corrosive saltwater environments.
Exactly. So getting a $13 million contract to protect these things is a massive validation of their technology. And it's not a one-off. It ramps up through this year and all the way through 2028.
So that's the visibility. That's why the market started to change its mind. The margin problem in Q1, the noise, started to seem a lot more tolerable when you have a $13 million contract providing a clear signal for future revenue.
You've hit on the exact insight. And it wasn't just Brazil. Let's touch on China quickly. Net sales there grew 23.5%, almost $5 million.
And management made a point of saying most of those sales are for domestic use inside China.
which is a really smart strategic move. It insulates them from a lot of the tariff risks in geopolitical games. They're serving China's internal market, which is massive.
Okay, so we've got undeniable growth, a massive contract win. But we have to circle back to the margin issue because this is where the execution risk is.
It is. They had to spend money to get this growth. Their operating expenses were up, but only modestly, about 2.9% to 9.7 million.
And that was for things like hiring more salespeople, upgrading systems.
All strategic investments. And this is the absolute crux of their strategy now. They essentially told investors, we've made the investments. Now our plan is to keep operating expenses flat while sales keep growing.
Is that like the old saying, we paid to build the stadium, now we just need the ticket sales to fill it up?
That is a perfect analogy. It's all about operating leverage. The fixed costs, the sales force, the new systems are already baked into the numbers. They're not going to do big cuts that might hurt their growth. They're going to let the accelerating revenue from that Brazil contract just absorb those costs.
So every new dollar of sales from here should be much more profitable.
It should flow through to the bottom line much more efficiently, widening that gap between gross profit and expenses. That's the plan anyway.
And that context explains the crazy whipsaw in the stock price perfectly. The stock gapped down 8.5% at the open.
Pure panic over that 36% gross margin.
But then, as the institutions and the analysts actually read the transcript and digested the story, the fixed costs, the $13 million contract, they bought it all back.
The panic over the margin volatility gave way to confidence in the operational narrative. It's a classic story of the market mispricing short-term noise and ignoring the long-term signal.
So the entire bull case now just hinges on management actually doing what they said they'll do. They need to show that gross margin improving quarter by quarter.
The conversation has completely pivoted from can they find growth, which Q1 answered with a huge yes, to can they execute profitably.
Let's touch on the joint ventures, the JVs, really quick. They're a big part of their global footprint, but the numbers aren't consolidated.
Right. And it's a bit of a mixed bag there. Unconsolidated JV sales were up a little, about 3%, but their operating income is actually down 5%.
So again, that profitability pressure is showing up elsewhere too.
It is. They specifically called out weakness in their German JV. And for a company like this, German industrial health is a really important barometer. So that's a bit of a yellow flag. They're hoping for some economic stimulus in Europe to help turn that around.
Okay, so outside of sales, what are the other big priorities for 2026?
Two main things. First, paying down debt. They have about $12 million outstanding, and they want to use their expected cash flow to really bring that down.
Which strengthens the balance sheet, always a good thing.
Yep. And second, they're still pushing hard on NATUR-Tec. They really believe they have a best-in-class compostable plastic business, but they're still sort of chasing those really big needle-moving contracts to prove it can scale.
So the stage is set, demand is there, costs are supposedly flattened, and the clock is ticking for them to prove that this operating leverage thing is real.
Exactly. The narrative shifts from growth to execution.
Which brings us to our favorite segment. This is not financial advice. This is where we take the setup from the call and pitch a bold, maybe even outrageous, but plausible trade idea.
And I think this one sets up perfectly for what I'd call a Q3 margin arbitrage play.
Okay. Lay out the thesis for us.
The trade is basically a bet that management is 100% right about two things. First, that the Q1 gross margin squeeze was just noise from those lead times. And second, that the $9.7 million in operating expenses are now actually fixed.
They're done spending.
They're done building the infrastructure. So the thesis is this. When the revenue from that $13 million Brazil deal really starts hitting the income statement in scale, probably in Q3 or Q4, it's going to run smack into that flat expense base.
And the leverage effect kicks in.
It acts like a multiplier. You could see a dramatic positive surprise in operating income that the market is just not pricing in right now.
So you're betting on a re-rating of the stock.
That's the trade. The market sees them as a lumpy niche player because of the inconsistent margins. You're betting on a re-rating to a compounder with proven execution once that gross margin number ticks back above, say, 37%.
That's the signal.
That's the signal that the noise is gone and the leverage is real. It's a conviction bet on management's ability to execute over the next 6 months.
It's a powerful idea, and that conviction is what saved the stock today. So to wrap this up, NTIC proved demand is not their problem.
Not at all. They delivered record sales, landed a monster contract. The entire investment case now rests on one thing: execution. Can they prove the margin slip was just noise? That's what we have to watch.
Which leaves us with a final thought for you, the listener, to mull over. You have these two major growth vectors. On one side, ZERUST Oil and Gas, which is growing like crazy and just locked in a stable long-term contract. And on the other, you have Natur-Tec Bioplastics, which is still chasing those big wins, but is playing in a potentially enormous market for compostable packaging. So the question is, which of those two provides the most defensible, highest quality revenue stream for NTIC over the next 3 years? Is it contract stability or is it market size potential? Something to think about.